Hello everyone. So today I am going to continue our last class problems based on the cost method. So we are in chapter 4. We are preparing the consolidated financial statements after acquisition. And this was the last question I discussed based on the cost method. And last class we completed first two columns like trial balance and the elimination entries. So today we are going to complete non-controlling interest and the consolidated balances. So here you already know that we prepare income statement based on the parents company and subsidiary company. We prepared retained earnings based on parents company and subsidiary. And we also prepared balance sheet based on parents and subsidiary, but we have yet make it consolidated. Okay, so this is the important part. And also we did several elimination journal, right? We had several elimination journal based on this. This is the journal entries. We close our investment accounts. We established non-controlling interest, and we close subsidiaries equity account, right? We close subsidiary equity account. We close parents company's investment account. We established NCI, and we find a difference. And what we did, we allocate the difference to the goodwill account. That means we close the difference and we allocate it to the goodwill account. And as it is a cost method, we know that the dividend declared by subsidiary company, we record it as our dividend income, and this dividend income is considered as intercompany transactions. So this is the cost method, and according to the cost method, only one intercompany transaction is the dividend. Okay, and we should close this kind of intercompany transactions because dividend, I told you that dividend already included under the net income because company paid dividend from net income, right? Net income transferred to retained earnings, then company paid the dividend. So as we already record dividend income, so we have to, and it is from net income. Okay, so dividend income already reflected in our net income, so we have to eliminate this intercompany transaction. So we remember that as it is a cost method, we have only one intercompany transactions, it is dividend. Why it is called intercompany? Because subsidiary company declared dividend and parent company received this dividend, right? They have some intercompany transactions. And as we know that dividend is connected with net income, and we already recorded net income in the income statement. So this kind of dividend should be eliminated. So these are the elimination journals, and you can see that all debit items we put under debit column of elimination, and all credit items we put under credit column of the elimination. So we did here. Now we have to think about the non-controlling interest income statement part and the non-controlling interest about the balance sheet part. Because we see that we have another important column for the worksheet is non-controlling interest. Okay, so non-controlling interest, some part are related with income statements, some parts are related with balance sheet equity account. Now we have to calculate them and put them under this column. First, come here. So this is the non-controlling interest based on net income. And we know that net income of S company, subsidiary company. Net income of subsidiary company, we know that it is $26,000. $26,000 net income in the subsidiary company, right? And this 20 and as with the parents company acquired 95% of this net income. And we have to establish NCI, remaining 5%. Remaining 5% goes to non-controlling interest. So this 19,000 is the part of the parents company. Now we have to find something for non-controlling interest. So you can see here, net income of subsidiary company is $26,000. $26,000 is the net income of subsidiary company, and NCI percentage of net income, it is 5%. Why 5%? Because 95% goes to parents company. So this is the total net income. This is the total net income of subsidiary. 95% goes to the parents company. Okay, and 5% goes to the non-controlling interest. So NCI net income from subsidiary is 1,300. This is the non-controlling interest NCI. This is the non-controlling interest NCI. Now, last class I told you that this net income is parent company, right? This net income is subsidiary company. Clear? But from this net income, parents company will receive, okay, parents company will receive 95%, and 5% goes to NCI. That means this is the NCI column here. Do you understand? I repeat again, parents company's net income, and this is subsidiaries company's net income. It is 100%, right? $26,000 is the 100%. So when we prepare consolidate here, you can see that when we prepare consolidate here, then parents companies plus subsidiary, right? But not 100% subsidiary, because we have 5% NCI. We have 5% NCI. So this 5% of this $26,000 is here, right? Non-controlling interest. That we already calculated. That we already calculated here. So this is the net income of NCI, and it comes from subsidiary company. Do you understand up to here? Now we can prepare the consolidated part. Here you know that sales revenue. What is the normal balance of sales revenue? Normal balance of sales revenue is credit. Okay, normal balance of sales revenue is credit. Now this is the net income of parents company, sales revenue of parents company, and this is the sales revenue of subsidiary. And here we know that consolidate means P plus S, right? P plus S. So both are the credit. Both are the credit, and we don't have anything here. We don't have any information under elimination or NCI. So we have to add these two together, and this is the consolidated sales revenue. So consolidated sales revenue is $340,000. This is the consolidated sales revenue. Then we are conducting now the cost method, right? And according to the cost method, dividend income is also revenue. Can you remember? But under equity method, dividend is not revenue. We are solving cost method, so dividend income is our revenue, and we know that revenue normal balance is credit. Revenue normal balance is credit. So this is parents company received $19,000 dividend. From whom? From parents company, right? From parents company, so they record dividend credit. Okay, and we know that this dividend is intercompany transactions, right? So we eliminate them. So why we eliminate them? Because this dividend already reflected in our net income. Okay, already reflected in our net income. So we eliminate them. So credit and debit, look at here. What is the relationship debit and credit? It is negative relationship. Because we know that debit plus, but debit credit minus, right? So one is debit, another is credit, ultimately it is zero. Now we can calculate our total consolidated revenue. Total consolidated revenue is this amount. This is the total consolidated revenue. Clear?
Yes.
Then cost of goods sold, normal balance is debit. Cost of goods sold. So in the exam, you no need to show me this debit and credit. This is for your reference. So we know that cost of goods sold, normal balance debit. Now this is the cost of goods sold of parents company. This is the cost of goods sold of subsidiary company. Both are debit. We don't have any information here. So debit and debit now plus. This is called consolidated cost of goods sold. So consolidated cost of goods sold is $170,000. Okay. This is the consolidated cost of goods sold. Then operating expense, normal balance also debit. And we have parents companies operating expense. We have subsidiary companies operating expense. We don't have anything under elimination and NCI. So the total is $34,000. Now we know our total revenue, we know our expense, we can calculate the total expense. So total expense is $204,000. $204,000 total expense. Now net income, right? Net income, look at here, parents companies plus subsidiary, right? Parents company, because we are here, we are consolidated part, parents plus subsidiary. So parents company 129,000, subsidiary company 26,000, and it is, you know, that net income normal balance is credit, right? So this credit and credit plus. And if we write here $136,000, what is the mistake here? Can you tell me? Because we know that it is P plus S, right? It is P plus parents company's net income and subsidiary company's net income $130,000. If I keep up to here, what is the mistake? Mistake is from here, 26,000 is included here, right? 26,000 is included here. But 26,000, although it is included here, but it is 100%. But our share, parents company share is only 95%. Right? Parents company share is only 95% because it is net income. Net income, parents company 95%, subsidiary 5% we write here. That means this amount, this 1,300, actually we have to deduct from here. We have to deduct this money from here. So this is the total net income, okay? P plus S. This is the P plus S net income, clear? But we know that from here, some part goes to NCI. Some part goes to NCI, we already know the number. So as it is the consolidated part, okay, although you already recorded it separately, look at here. Although this is totally separate, right? This is a separate column. And this is the consolidated column, right? Do you understand? So also we record it separately, but we have to show it here again because this money actually deducted from the net income of subsidiary. Do you understand? Because this is totally individual column, right? Individual column, and this is the consolidated only P plus S. Here we should come only P plus S, no not controlling interest. If any not controlling interest amount included, we have to deduct it. So this 1300 is included here, right? So we deducted it because this column is only for parents and subsidiary, not for non-controlling interest. Now we can add this column because we done up to here. So if we make it total, right? If we make it total, then we can make it, this is here. And this total is 134,700. So do you understand this column? This is the total. This is the total. Okay. Now I told you that this is the pink color. This is the pink color. So this net income will go under retained earnings because retained earnings beginning balance plus net income. You remember, right? Beginning balance net retained earnings beginning balance plus net income, right? So this net income, this pink should come from here. If I delete this now, for example, if I delete this now, so this net income, this is came from here. Clear? So you copy it, look at here, I copy it and I paste here. So don't be confused. This number came from this net income. Okay. Now we see that we have beginning balance of retained earnings because we are now consolidated part. Okay. Consolidated part. So this is the beginning balance of net income, beginning balance of retained earnings, parents company, subsidiary company. Then parents company's net income, subsidiaries company's net income. Then this is the dividend. Look, it is minus. So this $20,000 dividend declared by parents company declared 20,000, subsidiary also 20,000. Do you understand? Both company declared dividend $20,000. Yes. Now what is the problem here? Problem here is this $20,000 dividend. If we add here, look at here. So we have one credit item anyway. So this is $20,000 dividend from subsidiary, but parents company only can get $19,000. Why? Because parents company share is 95%, right? Parents company share is 95%. So this is the NCI. Look at here, NCI. As it is minus, okay, as it is minus sign. So NCI is going to get how much? If dividend is $20,000 for subsidiary, parents company will receive 95%. How much subsidiary is going to receive? How much subsidiary is going to receive here? Do you know how much? 1,000. Yes, very good. And it is minus item, right? It is minus. It is minus because the sign I put here, sign here. If you don't put sign here minus, you can do this. Do you understand my point? Either is fine. I put first bracket because it is minus. And if you do not put first bracket, you must write here minus sign. Okay. Now it is your choice. Anyway. And you can keep both, no problem. You can use minus sign here and you can use first bracket here, no problem. Either is fine to me. So look at here, $20,000 is the dividend of subsidiary, $19,000 goes to parent side, $19,000 goes to parents, and $1,000 goes to non-controlling interest. Clear? Now calculate the balance. Now calculate the balance. How much balance here now? 300, right? 300, because this is the net income, and from net income company paid dividend, right? Company paid dividend. So the balance, retained earnings ending balance is $300, and here retained earnings ending balance is 154,700. 154,700. Now, this is the retained earnings ending balance. Look at here, under balance sheet. Under balance sheet, we have another part, retained earnings ending balance. I delete this part, for example. I delete this part. So look at again. Previous class, we put this number, but I can delete it now. Why I can delete it? Because we already have retained earnings ending balance, okay? This row and this rows, all numbers should be similar. Clear? You understand? So I copy and paste here. I copy and paste here. So I repeat again, retained earnings ending balance, we already calculated under which statement? So this is another separate statement. First we done income statement, look at here. First we done income statement, then we prepared retained earnings statement. And retained earnings statement we prepared and we find the ending balance, okay? All goes to under balance sheet, okay? Now if we prepare the balance sheet, we prepared the balance sheet, then we do more workings later on. Cash, again, this is our balance sheet, and we know that cash normal balance is debit. So this is the parents company's cash, and this is subsidiaries company's cash, right? Debit and debit plus, and we don't have anything here. Debit and debit plus, and it is $92,000. $92,000. Then accounts receivable normal balance also debit. So parents company is $32,000, accounts receivable debit. Subsidiary company is $29,000, accounts receivable debit. Debit and debit plus, and it is $61,000. Then inventory normal balance debit. Parents company is $30,000 inventory debit. Subsidiary company is $16,000 inventory debit. This debit and debit plus. So we put here $46,000. Now investment in subsidiary normal balance is debit. Normal balance is debit. So $160,000 debit for parents company, but subsidiary company don't have this account, right? Don't have this account, and we already eliminate this. In which part? Eliminate this in the credit side, right? Based on the elimination journal, you can see that. Based on the elimination journal, it is credit, right? It is credit. So debit $160,000, you can see this one. Debit 160, credit 160, we don't have anything, right? Zero. Then plant and equipment normal balance debit. This is the parents company's equipment debit and subsidiary company's equipment debit, debit and debit plus, and it is $187,000. $87,000. Same land normal balance debit. Normal balance debit, debit and debit plus, and it is $63,000. 63 or 60, 63, yes. $63,000. Now, if you remember our elimination journal, first we record difference debit, right? First we record difference debit, then we record difference credit. Why? Because this difference, according to the question, the difference is going to allocate to the goodwill account, and goodwill is our asset. Goodwill is our asset account, right? So we close the difference and transfer this money to the goodwill asset account according to the question. Clear? So we copy this, okay, here. So first we create a new cell for difference. Difference first debit, then difference credit. Can you remember? Like here, difference first debit, difference then credit. Okay. So it is nothing, 0. Then we transfer difference to where? We transfer difference to the goodwill account, and goodwill is our asset. So according to this question, subsidiary don't have any goodwill, only this goodwill is going to record. Okay, now they become together, right? Now they become together, parents and subsidiary, and they record the goodwill. They record the goodwill. It is debit. Anyway, we put the goodwill here. Now we know these are the assets. These are the assets of parents company and subsidiary company. Okay. Then we calculate the total assets. So total asset is 464,000. 464,421. This is the total asset of parents and subsidiary. Now liability. We know that accounts payable normal balance is credit. So this is the parents company's accounts payable, this is the subsidiary company's accounts payable, credit and credit plus, and it is $31,000. Then other liability normal balance credit. So we have only 2 credits, we don't have anything here. So credit and credit plus, it is 15,000, no, 30,000. 30,000. Then common stock. This is equity account, you know that common stock is equity. And we know that normal balance is credit. Now parents company's common stock credit, subsidiary company's common stock credit, and 120,000 elimination credit. Sorry, debit. These 2 accounts are debit and credit. 120,000 credit, then we eliminate this debit, so it is 0. So we only have parents companies. We only have parents companies common stock, because subsidiary companies equity account is going to eliminate. Same contributed, other contributed capital, it is a part of the equity. It is a part of equity, right? Part of equity, and this 2 is going to eliminate because additional paid-in capital credit, additional paid-in capital debit, it is 0. We only have, who will survive? Parents companies additional capital is survive. So we know asset, liability. This is liability, this is common stock, and this is retained earnings. So these 3 are the equity, you know that. These 3 are the equity. Equity again, I copy from where? I copy from here, right? I copy this and I paste here. I paste here. Now we have 2 remaining cell, one for NCI beginning balance. Okay. NCI beginning balance, and we have NCI ending balance, but we don't know about the ending balance. We don't know about the ending balance. So we know that NCI, okay, this is the NCI column. This is the NCI column, so we need beginning balance. Okay, we need beginning balance and we need ending balance, because this is the NCI column. NCI column. So we need beginning balance, we need ending balance, and ending balance of NCI will transfer to the balance sheet. So we need these 3 information. We need these 3. So one is given. So when you prepare non-controlling interest section, we already know what is the beginning NCI. We already know the beginning NCI, right? Yes. So we already knows this. We already know the beginning NCI. So if we want to know the ending NCI, we have all information here, but I can show you a proof how to do that. How to do that. So this is the balance sheet part here. So this is the beginning. This is the beginning NCI. Right? We have beginning NCI and it is the amount. And we know that this account increased by net income and decreased by dividend. So net income of S company. So some part of the net income, and it is 5%. You remember that $26,000 was the net income times 5%. Times 5% goes to the NCI, right? $1,300. And dividend of S company. So S company declared $20,000 dividend times 5%. 5% is the NCI dividend, and dividend is minus, you know that. Dividend is minus $1,000. Now, after that, we should have the ending balance. Ending NCI. And ending NCI, you can see that it is 8,721. 8721. Okay? Do you understand? Beginning balance we calculate from the very beginning. Beginning balance plus net income minus dividend. So everything is here. You can see that everything is under here. Beginning, this is the net income plus, right? And dividend minus. Clear? Yes. So we know the ending balance is 8,721, and this number we transfer to the consolidated balance sheet. 8,721. Now, if you want to make sure that your answer is 100% accurate, okay, this number, you can do a workings to calculate whether this 157,500 of retained earnings is an accurate number or not. Okay, is an accurate number or not? We can do some workings to make it proof. Now I am going to show you. I am going to show you whether this number is accurate or not. Okay, this number is accurate or not. Consolidated retained earnings. So we know that consolidated retained earnings is this one. Consolidated retained earnings is this amount. Is this amount. Now I am going to show you the proof whether this number is accurate or not. Okay, whether this number is accurate or not. So first is start with beginning balance. Beginning balance of retained earnings. Look at here. This is the beginning balance of retained earnings. Look, $40,000 for parents company, $23,000 for subsidiary, right? And again we eliminate $23,000. So we only have beginning balance $40,000. Okay, so if you cannot remember, go to my previous class why we eliminate retained earnings of subsidiary. So these two accounts eliminated. So we have only beginning balance $40,000 of parents company. So this is beginning balance $40,000. Okay, beginning balance $40,000. And it is the consolidated balance sheet. You know that it should be P plus S. P plus S. So this beginning balance is only for P. Why not S? Because S is eliminated, right? S, subsidiary companies retained earnings beginning balance already eliminated. So although consolidated means P plus S, but here we should only write parents company's beginning balance. Clear? Then we know that beginning balance plus net income. This is the formula. I can write first for you. Minus net loss minus dividend equal ending balance. This is the formula. Okay, this is the formula. Beginning balance plus net income. If we have net loss, then minus net loss. If we have dividend, then minus dividend, right? Now remember what happened to our question. In our question, because it is net income, look at it. Net income should be P plus S, right? Net income should be P plus S. So the net income of P company, and we have another net income of S company. Then minus dividend. Dividend declared of, or you can just write dividend of P company. Then minus dividend of S company. This is the formula, right? And the result should be this one. The result should be this one. If your result is not this one, it means that you are going to make mistake. Okay. So net income of parents company, it is given in the question here. $129,000 is the parents company, right? $129,000 parents company and $26,000 subsidiary. So I write here 129 first. So net income of parents company 129,000, right? If you write $26,000 here, it is right or wrong? Wrong, right? Because parents subsidiary company's net income is $26,000. Subsidiary company's net income is $26,000, but it is not 100% your. Yes, very good. Only 95%. 95% is yours. So the amount here is 24,700. Clear? Now, how much dividend parent company declared? According to this question, both declared 2020. What is the dividend? Yes, both company declared $20,000 dividend, right? Yes. So parents company's dividend minus $20,000. And again, if we write $20,000 subsidiary company's dividend minus, it is our mistake, right? It is our mistake. Why this amount is mistake? Because it is not 100% we receive. Although subsidiary company declared $20,000 dividend, we only received 95%. And it is $19,000. $19,000. Now, when we apply this formula, beginning balance of retained earnings, it is only for P because subsidiary already eliminated. The net income of parents, net income of subsidiary minus net dividend of parents, dividend of subsidiary. The remaining is the 154,700. Okay, and this is, look at here, 154,700 or 154,700. If this number is accurate, then we know that, and we also calculate this. So if this one and this one is accurate, okay, try to understand. If this one and this one is accurate, the total amount should be this account. The total should be this account. Because these two, I repeat again here, these two I already give you the calculation. These two account already calculated here. This one and this one. So you can do this kind of workings to make sure that this number are accurate. Okay, and we can put here, and we find that this is the total account. This is the total account. So this is the worksheet according to cost method, and this is consolidated financial statement. Why it is called consolidated financial statement? Because we have several financial statements here: income statement, we have retained earnings statement, we have balance sheet, right? So that's why it is called consolidated financial statements. Please check the question very carefully. If I ask you to prepare consolidated balance sheet, it is chapter 3. Okay. If I ask you to prepare consolidated financial statement, it is chapter 4. Then remember, chapter 3 is about consolidated balance sheet, and chapter 4 is about consolidated financial statements. So read the question carefully. So this chapter is about consolidated financial statements. Anyway,